72E is the second of three critical tax codes I think would be in your best interest to understand. The first is 7702, the third is 101A. In this, we're going to look at the actual code, the Internal Revenue Code for 72E. We're going to look at it's much more detailed and longer than you probably think. And if you think 72E allows you to grow money tax-free inside of an insurance contract, I'm going to show you one, how that's not always true, and in some sense, is never true. And third, what we're going to look at is how this actually works in practice. Hi, I'm McCluskey, and it's one of my goals and desires to make these videos as informative and helpful as possible. Do me a favor at the end, leave some feedback. What could I have done better? What stunk? Whatever. Thanks. So first, 72E is not just showing you how you can grow money inside of an insurance contract tax-free. So for reference, to get to tax code 72E, we have to look under, and this is Title 26, which is the entire Internal Revenue Code. We have to look under Subtitle 8, Title Income Taxes, Chapter 1, Title Normal Taxes and Surtaxes. Under that is Section 1B, Title Computation of Taxable Income. Under that is Code 72, Title Annuities, or certain proceeds of endowment and life insurance contracts. And finally, 72 lowercase e, amounts not received as annuities. And under 72E, there is 12 more bolded sections, and under that, 20 more sections. Under that, more sections. So it's like the painfully long outline of an English paper that you had to write before writing an essay. Not fun. Now, 72E, like I said, it was titled Amounts Not Received as Annuities. So for example, annuities are tax deferred. So let's say you put money into an annuity, whether it's a rollover from a 401k or an IRA, or just, let's say a Roth IRA, for example, money that's been post-tax. That money, after it grows, when you start to withdraw, is going to be taxed. So this is money that comes out of one of those kind of contracts that's not being treated as an annuity. Otherwise, some would say non-taxable, but not exactly, but kind of. So first, just to get an idea, let's read right under 72E the kind of definition here, and then we'll dive into it a little farther. So in general, it says this subsection should apply to 1, any amount which is received under an annuity, endowment, or life insurance contract and is not received as an annuity. So exactly that definition we just gave. And now, without reading the entire code, because as I mentioned, there's so many sections, what I want to look at is 72E, section 4, capital A. Now, the reason for that is this is titled Loans Treated as Distributions. So this is what most people care about, especially people who are looking into like an IUL or a whole life policy that they're using for tax-free income, etc. So we're going to look at this, and then we're going to see what this actually means in terms of taxation. So very important here to understand. So first, any taxable year, an individual, 1, receives directly or indirectly any amount as a loan under any contract to which this subsection applies, or 2, assigns or pledges or agrees to assign or pledge any portion of the value of such contract. Now, given those two, it says, such amount or portion shall be treated as received under the contract as an amount not received as an annuity. So it's not going to get that tax-deferred treatment. However, it says, the statement we just read, the preceding sentence shall not apply for purposes of determining investment in the contract, except that the investment in the contract shall be increased by any amount included in gross income by reason of the amount treated as received under the preceding sentence. Now, the term that's really key here is investment. So for example, when we max fund a life insurance contract or an IUL, a whole life, whatever it is, and we are making sure we keep it within the corridors of TEFRA, DEFRA, and TAMRA, which we'll go over in different videos, we have it structured so we have the least amount of life insurance possible for the most amount of growth without it becoming a taxable event, otherwise an investment. So when that money grows, it's not considered an investment. We don't want it to be considered as an investment. Investments, in general, are taxed. When it's not considered an investment, that's where we get the tax-free benefits. So let's say you had $500,000, you wanted to put it into a policy. Now, under TAMRA, so that's of 1888, Technical and Miscellaneous Revenue Act, you'd have to spread that out. So let's say you put it in over 5, 6, 7 years, kind of depends on your age, how much, how frequent, etc. But you say, well, I don't want to wait 5 years to put, $100,000 in each year. I just want to put the $500,000 in right now. Well, you can do that. You'll still get the tax-free growth. If you die, which we'll go over in 101A in the next video, it would still transfer tax-free, but if you wanted to access that at any point while you're living, what's going to happen is it's going to be taxed. You don't have the tax-free access even if it's due to a loan. So that's where it would be considered an investment. And then 72E doesn't apply how you probably wanted it to. Okay, second thing I want to cover here is if you thought that 72E allows for money to grow tax-free inside of an insurance contract, I wanted to show, one, how, well, it's not always true, and two, in some sense, it's never true. Now, what I mean by that is money inside of an insurance contract is technically growing tax deferred. Yes, tax deferred, not tax-free. Even in Doug Andrews' book here, for example, one of the guys I learned from, he even states there's a chart that compares all the vehicles that shows tax deferred. Now, here's the thing. When that money is growing tax deferred, it's only taxed once you withdraw it. So like an IRA or 401k, money is growing tax deferred. When you take withdrawals, you pay taxes. Now, the key to avoid that is you never withdraw. You just take loans. The loans aren't taxable as we saw before. Money's growing tax deferred. It only works correctly if you're taking the loans. So the second thing I want to go over here is you need to be careful about how you understand money growing tax-free inside of an insurance contract, because in some sense it's not actually true. Money is growing tax deferred. Now, we're going to go over, there's a couple subsections in this that really make sense and that you really need to be careful when understanding. So there's loans versus withdrawals versus surrender charges. So let's say you've put in money, it's grown, and now you're at the point where, okay, I'm ready for my tax-free income that you guys talked about. Let's do it. So there's loans and withdrawals. Now, like your regular accounts, like 401ks and IRAs, the difference is with those you're taking withdrawals. For the IUL to work and to get it tax-free, you have to take loans, except you can actually withdraw because they're taxed FIFO, first in, first out. Everything you put in, you can pull that out without that being taxed. Anything beyond that FIFO treatment, that's where you're gonna get the tax deferred status. So all of that money, all of the gains beyond the money you contributed is taxed, and it's gonna appear on your 1040 tax return in whatever bracket that you're in. Also, another thing could be surrender charges. You could be subject to those if you're taking withdrawals, depending on when in the contract you're doing that. So again, that's not something we'd recommend. Typically what we're gonna see is people actually taking loans instead of the withdrawals. So one way I kind of like to explain this to people who are more familiar with like a Roth IRA, for example, is the kind of tax-free income and how we receive that needs to be carefully understood within an IUL or whole life, similarly to how the tax-free income works in a Roth IRA, where if we take it out early, for example, there might be that 10% charge. Now, you can obviously retrieve your principal in a Roth, but there is some nuances to how you go about it, and that you don't just let it go tax-free and take it out anytime. That might be silly. With an IUL, it's similar in that there is some nuances. We're not doing withdrawals. Those are taxed, except for your principal that you put in. We are doing loans, and those are tax-free. Third here, let's look at an example of how this actually plays out in practice. So let's say you put in $500,000 and it grew to, let's say it's 25 years later, it grew to $3.5 million. You have to have 5% more insurance than you do cash value. So that'd be $3.675 million of death benefits, which, little side note here, keep in mind, that's $175,000 of insurance, not $3.675 million, because the $3.5 million is cash value. You're only paying for $175,000 in insurance. That's why the fees aren't as high as a lot of people say they are. Important note to make there. And keep in mind, this is just an example. It doesn't always play out in practice like this. Similarly to how if you add, let's say, investments in a mutual fund or a retirement account of some sort, and you're taking out, let's say, whatever percent a year, it's not going to be the same amount every year. Like if the market goes down or the market goes up, you might be able to take out more or less. It all kind of varies, so this is just an example. You put in $500,000, it's grown to $3.5 million, you have a little bit of insurance above that. You are now at the point where you say, cool, I have this money, I'm ready to start reaping the benefits and using this as tax-free income. How do I do it? So the first thing, if you wanted to withdraw, again, I don't always think it's the smartest, but you could withdraw that first $500,000 tax-free. You're retrieving the principal that you put in. it was post-tax dollars to begin with. That's the first thing. Now, beyond that, again, usually I'm going to just start with loans instead of retrieving the principal first. But even if you did retrieve the principal, beyond that, we start taking loans. There's a couple different types of loans. There's fixed loans, and then there's variable or indexed loans. Typically what this is going to be is, let's say they cap you at like 5%. They're going to say, all right, we're going to give you a variable loan rate that's going to fluctuate based on interest rates, but it'll cap at 5%. Meaning you're going to borrow your own money out, again, let's say at 5%, but that same money is going to stay in the index, indexed to that account, or linked to the market, the fund, whatever you want to call it, and performing as it does. So if that fund does 0%, you still paid me 5. But if you took out that money at 5 and spent it, and it's money you don't even have anymore, but the index did 10, and let's say the cap was 10, you're actually going to get the full 10% on that money. So you got 10% on the money, you paid 5, you got a spread of 5% on money you've already spent. Now, it doesn't always work as beautifully as that. It's not as simple. Again, it fluctuates. I always recommend consulting an expert when looking at these things and sitting down and looking at software that's kind of showing you the different projections and the different scenarios. So we'll do more videos where we actually go into that. I'll sit down and have software that can show you not just a flat rate, but varying returns and how that affects your income or your account value, your surrender value, death benefit, etc. So we'll do all that in separate videos, but that's 72E, pretty interesting. Hopefully answered some questions for you guys. If you do have any, leave them down below, and stay tuned. We'll go over 101A in our next video. See you there. Subscribe.